On the floor of the NYSE with the CEO of IndexIQ. They are launching a new ETF, as I had mentioned. It's the Emerging Markets MidCap ETF, and it gives you the ability to play in midcap stocks and emerging markets. Obviously, it makes sense. But you guys focus on commodity-based ETFs, commodity-based sort of hedge fund activity. So explain what this is.
That's exactly right. Well, this new ETF, EMER, is the first way to play in midcap stocks in the emerging markets. The reason why it's so exciting is the fact that when people invest in emerging markets, they want uncorrelated returns, they want diversification. But unfortunately, when you invest in the large cap ETFs, what you're getting is a lot of exporters that are really plays on developed markets like the United States. So you're not getting that diversification. This way, you're getting a lot purer play on the actual home economies of these emerging markets.
Domestic companies in those emerging markets that it's really difficult for individual investors to actually get their hands on.
That's exactly right. Exactly right. And they have a higher dividend yield. They're lower volatility, and they're undervalued relative to the large caps.
So what kind of companies are we talking about? When you say mid-caps and emerging markets, what are the regions that you're talking about? What are the industries, and what are the sort of sizes?
Sure. So the ETF covers 20 countries. The top 3 countries are Taiwan, South Korea, and South Africa. So it's well diversified, but it's a little more heavily weighted into those countries that are a little more developed with more liquid capital pools, which is what you want. On the sector diversification, has very different sector allocations than the large caps. We're heavier in the consumer staples, consumer discretionary, and the industrials, rather than energy, materials, and financials.
Hey, Adam, I love the emerging markets, but when you're talking mid caps, we worry about transparency issues with some of the larger cap names when it comes to emerging markets. How are you so confident about investing in some of these mid cap names where you maybe aren't getting all the information you need?
Well, sure, there's always that risk with any index investing. What you need is an index developer, which we develop all of our own indexes, that scrub through the companies to make sure that we're getting the best quality companies, or as good a quality as we can tell from the accounting standards in those countries themselves. We also screen for liquidity, very severe liquidity screens in terms of shares traded and dollars traded per day and average and minimum market caps to get into the index to try to protect the investor against those things.
Let me ask, Carol and I were talking earlier, why would you buy this instead of just be invested in a hedge fund? Obviously, you don't have to worry about the 2 and 20 fee. You don't have to worry about having a minimum amount to invest. That makes sense. But you guys have to make money somehow as well. So what kind of fees, what kind of management structure do you have?
This is a very low fee product. It's 75 basis points, which we think is pretty inexpensive to gain access to 100 mid-cap stocks in these emerging nations. And we rebalance it annually. It's a very low turnover strategy, so it's not a high cost for the investor. So we need to make money by driving assets into our products, and we're out there educating people, and we hope to do well with this.
One other thing I always think about with ETFs is how do you align the underlying products with the ETF price? Because obviously the ETF can change as people buy and sell it.
Absolutely. Well, we price the ETF really based on the cost of putting the ETF together initially. So you know what? If it gets more expensive to run the ETF, hopefully our asset base is higher at that point and it pays for itself.
All right. Hey, Adam, thanks so much for joining us. Adam, Patti there, CEO of IndexIQ.